Bob Wines, old friend of mine from the Plant Moran days. Bob's an attorney and a CPA like myself and like Mike, except Mike's a CPA attorney, not an attorney CPA. Bob and I have been working together for years and years on a variety of things. Bob, you want to do a quick intro besides the fact that we both were old P&Mers?
Sure. After I left Plant Moran, I did startups in the tech space for about 25 years. Then I was in private equity. Since then, I've been working with a group called Insights 3. We're a consulting firm focusing on triple bottom line strategies. It's companies that are, the focus is strategies that are profitable while generating a positive community and environmental impact. And I asked Leon, why he really wanted me on this webinar, and he told me it was to build up MICPA member morale. And I asked him why, and he said, well, Bob, I figured anyone who can manage putting up with you for an hour can easily manage their business through a pandemic. So that's why I'm here.
Thanks, Bob. And we'll recognize that in the pandemic. I'll go mix up a quarantini and we'll go from there.
Perfect.
Our presenters for tonight are really good. You're in for a great treat. Mike Lorenz, old friend and great tax partner, very smart CPA, very smart JD, does a lot of things with us in terms of what we do with Cohen & Company. Mike Boncher, again, CPA and a manager at Cohen & Company. So I'm going to flip it over to Mike and Mike, which would be a great name for a rock group if we ever did that. But I
morning
just,
show.
Yeah. So Mike Lorenz, welcome and thanks for bringing this to us. And why don't you tell us how you want to do things on tonight?
Sure. Let me start by thanking the MICPA and Jim Jagger for hosting and monitoring the series tonight, and Leon for your brain trust in putting this series design together and getting this team out there, and certainly my co-hosts Gary Rose and Bob Wines for their content, which was really interesting. Let me tell you a little bit about Cohen & Company. We're an insurance, tax, and advisory firm, about 650 associates in 10 states through in the Midwest. We have 2 offices here in Michigan, St. Clair Shores and Detroit. I practice primarily in the tax space, and we're one of the fastest growing accounting firms in the country. I picked 3 topics to talk about tonight, and those 3 topics you'll all see are designed to generate immediate cash flow. So my colleague, Mike Boncher, is going to help me with some of those. We're going to do a slightly different format than we've done the other nights. So tonight we're going to jump into the topic. I'll run through the technical rules so that we all know what they are. Try not to be too deep, but enough so that we know what the rule is. And then at the end of each section, I'd like to do some Q&A and some discussion like we've done every other night on how this will best impact your clients in generating cash flow. So if that is okay, Leon, I'm going to get started with my first topic, which is qualified improvement property. So the Tax Cuts and Jobs Act of 2017 included a provision that effectively excluded qualified improvement property from being subject to the allowance for bonus depreciation. That's the big issue. It caused a lot of conversation, a lot of discussion on whether it could be fixed administratively, but at the end of the day, there was no administrative resolution, and along comes the CARES Act, which was an opportunity to make sweeping changes to the code for 168E6 as followed. The term qualified improvement property means any improvement made by the taxpayer to an interior portion of a building which is a non-residential real property if such improvement is placed in service after the date such building was first placed in service. It's a mouthful, and we'll probably get into some of those phrases. Next page for me. The technical correction amended the TCJA to include qualified improvement property provisions as if they were originally part of the Act. Therefore, the new rules apply to the QIP placed in service after 9/27/17 as if the Act had been placed in place at that time. Section 168E3E is amended to define that QIP is considered to be 15-year property. 15-year property is depreciated under Section 168 under the 150 declining balance method, switching to straight line. This change effectively allows taxpayers to claim bonus depreciation on property considered QIP. This is a big dollar issue. Now, you must keep in mind, if you elected to be a real property trade or business under the 163J rules, which were the interest limitation rules that you could elect out of, the QIP ADS life is 20 years. Therefore, it will not qualify for bonus depreciation for the years that that election is in effect. So we need to pay close attention to Revenue Ruling 2020-22, which covers the guidance on how to make or revoke those elections under 163J. A key piece of guidance recently released is Revenue Procedure 2020-25. The revenue procedure provided additional details and guidance on acceptable methods to implement the change in depreciation on qualified improvement property. Acceptable formats include either filing a Form 3115 to change from an impermissible method to a permissible method. The 3115 must be filed with a timely filed return or a superseded return before the extended due date of the original return. For 2019, returns currently filed without an extension and amended return with Form 3115 can be filed within the 6 months of the original due date. There is no requirement to file the 3115 on the 2019 return. If a 2019 return has already been filed and the taxpayer does not want to amend or supersede that return, the Form 3115 may be filed with the 2020 return. Alternatively, you may file an amended return back for 2018. Additionally, and a complex subset of this conversation is Form 8882. That is the administrative adjustment on partnerships subject to the centralized partnership audit regime and how those amendments would apply. That adds a significant layer of complication. Rev Proc 2020-25 does not apply to QIP placed in service by a taxpayer if the taxpayer either revoked or made a late real property trade or business election. For that, we have to go to Rev Proc 2020-22. So, what does that mean? What we are seeing is what we have done is sit down with many of our clients and done out a 10-year cash flow where we determine the factors that decide whether you want 163J or bonus depreciation. And what we have seen is that the leverage of the property, if it's a highly leveraged property and has high interest, generally the 163J rules have outweighed the bonus depreciation rule. Importantly, and I think we've talked about this, Bob spoke of this the other night, cost segregation studies still remain very beneficial and don't reduce the ability to have cost segregation and QIP as eligible increases in deductions. So I think at this point we'd like to talk about questions and answers or questions that anyone might have on this section.
So Mike, I've got a question right off the get-go. If I haven't been, obviously we were stuck without anything on QIP, so we didn't know what we could do.
Right.
All right. What are you telling clients right now? Do we go back and amend the 17 return, or are we amending the 18 return? And if so, are we getting a refund? What's the ramification to my dollars?
That is the question. Is what is the easiest way to get a refund? So, right. And I think what we're telling clients, and I'd be interested to see what the audience thinks, what we're telling clients is you got to look back 5 years and find out what year you want the carryback to go to. What is your 5-year carryback period look like? So
this interfaces with your NOL carryback.
Absolutely. Absolutely.
So can you give me an example, because it's wild. I mean, this is a wild thing. I'd like to see how this works. Tell me how it would work. I've got a piece of property. I did real improvements, and you go back and look at my return, and I didn't claim them on my prior 17 or 18 return. I didn't use 168J.
And if I go back to 13, 14, and 15, and you have losses,
yeah,
why not just elect it this year? Make it cheap. Make it easy.
Okay. Let's say I had gain. Let's say I made money in 13 and 14.
I probably would want to go back to the earliest year and carry it back and free that up.
Gotcha.
And then I'm going to check the tax rate, which is probably higher because the
Right.
rate almost certainly is lower this year. So if you can get to 13, you probably want to.
Mhm.
But if there's no benefit in it and it increased the administrative aggravation of claiming this, I wouldn't do it. Now, one of the issues that weighs in there, Leon, is there is some conversation on these administrative adjustments that if you have a huge loss and you can't use that loss,
Right.
it's treated as a credit, but not necessarily a refundable credit. So
Okay.
this is easy question if it's just you and me in the partnership and we've been in the partnership the whole time together.
Right.
But if there was 30 different partners back at 3 years ago,
And now there's 20.
5 new partners,
Right.
and so the decisions on the larger real estate ventures are more complex because they impact a lot of amended returns, a lot of administrative cost, and some of the developers and managers of those deals don't want to burden their passive investor with that aggravation. This is really more relevant to real estate professionals who are entitled to deduct these losses. So I guess you have to tell me, is it just you and me? And have we been partners for the whole 5 years? Let's go back and get the highest tax rate. If there's a bunch of other people that came in and out, and if we have huge losses that may not get utilized before we sell the property, I would think twice about how to apply this, particularly in the centralized partnership situation.
So say it's you and me. We rent the building to our CPA practice, or we rent it to some lawyers or something else. We got an office building. We rent it together. We've been doing this together. I have lots of clients like that who own buildings. And we've got qualified improvement property we made in 17 and 18. And it is just you and I. We just run back and go look at our 13, 14 returns. You sit down with me and we go through the 13, 14 returns. If we've got losses, we go back and use them. We get a refund. Right?
So if it doesn't matter, let's say the loss is 100 grand, and in both years, in both 13 and 14, we have the same amount of, we have made enough money that it'll be in the top bracket.
Yep.
And the 19 return is sitting on my desk. Let's throw it on the 19 return because now it doesn't cost you anything for me to file the return.
Okay.
But
All right.
if 13's a bigger income year, maybe we have to just pay the money to have us file that amended return for 18.
Gotcha. Now, if we're a big partnership, we've got shopping mall or whatever else the case is, and we've changed partners and all that, a lot more complicated then.
Absolutely. Especially since a lot of those losses may end up being passive anyhow. It may not actually generate cash flow.
Gotcha. Okay. Kind of cool. Interesting. A little technical. You got me there for a second. You made me go, what? Do I amend the return? Do I not amend the return? The answer is I sharpen my pencil, right?
I think you get a 5-year projection and you make an analysis and you decide what gets you the best cash flow. So it is a little bit technical. Let me ask, how are people finding this? So to the audience on the presentation tonight, have you gone back? How are you finding whether you have QIP in your various client base? Has anyone come up with a effective way to make sure that you've identified everybody that's not Leon and Mike and doesn't call you and say, here's I need my return amended? I'll wait a second and see if we get any wisdom from the group.
Yeah. We have been getting a couple chat questions, but they're pretty technical in nature. Can I ask one more question while we're waiting?
Sure.
I've always seen cost segregation as useful, but it seems like in this kind of times where we want to be grabbing for anything we can get our hands on. If I was doing a cost segregation study, I usually see those in the context of personal property taxes, where I can cut my personal property tax and some of those things. Can you just give me a quick run on why I'd want to do a cost segregation study right now with the QIP rules changed?
Sure, because they're unrelated. So your parking lot, let's say you have a shopping mall and it's a $100,000 or $1 million shopping mall, and the parking lot's 15-year life, and that never got carved out of the original purchase price at 39. So you paid your $1 million, but half of it's parking lot that you could have put into a 15-year life. You could have a much more accelerated depreciation on that parking lot, irrespective of the QIP that you put in to put a new tenant in.
So I could do that right now.
Sure, and you can do both of these at the same time.
Hey, by the way, everybody, if you want to ask questions, hit the chat button down at the bottom. I'm not sure everybody knows how to do that. So we've got quite a few people in the room. And if you want to ask us a question, just hit the chat button. So Mike,
So
that's pretty good. I like
I didn't
I
get
like
any
the second.
takers. I didn't get any takers on my
Move your
first
mouse around
question.
and it'll pop up.
Say it again, Jim.
Move your mouse around a little and the chat button will pop up. If you're sitting there stagnant for a while, it disappears and you've got to kind of pull up your menu bar.
Yeah.
So let me ask one more question to the audience, since I didn't get any advice on the QIP. Has for people who have clients that have made the real property trader business exception, have you seen the same outcome we have? That if you're highly leveraged, it's not worth reversing that? Or have you seen an example where you feel that the QIP great outweighs the real property trader business exception?
No takers, Mike.
No takers. All right, those are tough questions. If
They're a tough
anybody
one for
has,
me. You just taught me a bunch about this, and I'm supposed to know all these things because I remember I worked on the Tax Cuts and Jobs Act. So I looked with glee that they finally did a technical correction, and I was glad they did it. You've shed some light on it, and it's obvious that I'm going to have to do more research on this to see what happens on the carrybacks and how that works.
so we certainly are willing to continue the conversation on this issue. So if someone wants to follow up after the seminar, we'd be happy to discuss that. But at this moment, I think I'm going to move along to Michael Boncher, who's going to help us with the NOL rules.
Thanks, Mike. So if you could go to the next slide, please. So in addition to the changes made to qualified improvement property, the CARES Act also makes significant changes to the net operating loss rules, and also included technical corrections to provisions that were added by the Tax Cuts and Jobs Act that modified the NOL rules as well. So the Tax Cuts and Jobs Act eliminated the ability to carry back NOLs and limited the use of NOLs in a carry forward year to 80% of taxable income. The CARES Act now allows an NOL that was generated in a tax year beginning in 2018, 2019, or 2020 to be carried back 5 years. So the old carryback period was 2 years. The CARES Act allows for a 5-year carryback for NOLs generated in 18, 19, or 20. Taxpayers still do have the ability to waive the carryback period. That's still allowed, and to carry forward those NOLs indefinitely. The 20-year carry forward period for NOLs generated in tax years before 2018 is unchanged. So any pre-2018 NOL that's not fully utilized in the 20-year carry forward period does still expire. The rule limiting an NOL deduction that arises in a tax year beginning after 2017 to 80% of taxable income is suspended for tax years beginning in 2018, 2019, or 2020. It's important to note here that that change is only a suspension of the 80% of taxable income limitation. It is not a full repeal. As a result, any portion of an unused NOL that was generated in 2018, 2019, or 2020 is subject to the 80% of taxable income limit beginning in 2021. So if you could go to the next slide. Generally, an election to waive the carryback period is required by the due date of the return for the tax year in which the NOL was generated. The CARES Act carves out an exception to that rule for NOLs that were generated in tax years beginning in 2018 or 2019. The time for making the waiver election with respect to those 2 years is extended to the due date for filing the taxpayer's return for the first tax year ending after March 27, 2020, which was the date of enactment of the CARES Act. So in other words, a corporation with a calendar year end has until April 15th, 2021 or October 25th, 2021 if the 2020 return was properly extended. So there's some additional time that a taxpayer can have. They don't have to use that time, but it is available. So the CARES Act clarifies a provision in the Tax Cuts and Jobs Act when the 80% of taxable income limitation comes back in 2021, and an NOL deduction beginning in 2021 is now limited to NOLs that were generated in tax years that began before 2018, those that are not subject to the 80% of limitation, 80% of taxable income limitation, plus the lesser of post-17 NOLs, or a base in which the 80% of taxable income limit is calculated. And that base starts with taxable income, adds back deductions under Section 199 Cap A, which is the qualified business income deduction, and Section 250, which deals with deductions associated with foreign derived intangible income and global intangible low taxed income, less any NOLs that were generated in pre-2018 years. Previously, the 80% of taxable income limit was computed without regard to pre-2018 NOLs, and no adjustment was made for deductions under Section 199 Cap A or Section 250. So practically speaking, if there are still substantial pre-18 NOLs carrying forward into 2021, that taxable income, the 80% base most likely will be lower than it would have been under the original provision. However, if there aren't many, if the pre-2018 NOLs have been exhausted or there aren't very many left, the base, the 80% base may actually be higher than it was under the original and under the Tax Cuts and Jobs Act before the technical correction, due to the add back of the 199 Cap A and Section 250 deductions. The CARES Act also clarifies that the 80% of taxable income limitation and unlimited carry forward period both apply to tax years beginning after 2017. So there was a one-word drafting error in the Tax Cuts and Jobs Act that created some havoc for fiscal year filers in the 2017-2018 straddle period. The Tax Cuts and Jobs Act provided that the original legislation provided that the 80% of taxable income limitation was effective for tax years beginning after 2017, while the unlimited carry forward period and elimination of the ability to carry back NOLs was effective for tax years ending after 2017. For a calendar year taxpayer, this didn't make a difference because the first tax year beginning after 2017 and the first tax year ending after 2017 both would have been in 2018. But for a fiscal year taxpayer, that wasn't true. The CARES Act clarification clarifies that an NOL incurred in a tax year that began in 2017, I'm sorry, the original drafting of the Tax Cuts and Jobs Act caused a 2017-2018 fiscal year filer that had an NOL. That loss could not be carried back, received an unlimited carry forward period, but was not subject to the 80% of taxable income limitation. The CARES Act clarifies that all three of those changes now, the inability to carry the loss back, the unlimited carry forward period, and the 80% of taxable income limitation now all occur in the first tax year that begins in 2018. For forms 1045 and 1139, those are the forms that are typically used to carry back an NOL to generate a refund. Those forms are much simpler to file than a full amended return. Generally, those forms, the Form 1045 or the 1139, Form 1045 is used by any taxpayer that's not a corporation. 1139, Form 1139 is used by only C corporations, and those and those forms are typically due by the end of the tax year that follows the NOL year. Taxpayers that generated an NOL in a 2017-2018 fiscal year have until July 27, 2020, which is 120 days after the enactment of the CARES Act, to carry back the NOL using Form 1045 or 1139, make the election to waive the carryback period, or revoke an election previously made to waive the carryback period. So those fiscal year filers that incurred an NOL have until July 27th to make a decision of what to do with that NOL, or unwind a decision that has already been made with respect to that NOL. It's critically important that if you're filing a 1045 or an 1139 for a taxpayer in those circumstances, to reference Revenue Procedure 2020-24, as that RevProc provides guidance to ensure that the preparation and filing of the 1045 or 1139 is done properly. The CARES Act, unfortunately, did not provide that type of relief to any other taxpayer other than a fiscal 17-18 taxpayer, but the IRS is providing administrative relief for taxpayers that generated an NOL beginning in tax years beginning in 2018 and ended on or before June 30th, 2019, have an additional 6 months to file Form 1045 or Form 1139. And Notice 2020-26 is an important notice to follow when filing a Form 1045 or 1139 for taxpayers in those circumstances, to ensure that they're prepared and filed properly.
Let me jump in for a second here.
Sure.
So as you can see from this section, particularly for the practitioners that are on the call, a lot of technical provisions. And unlike the QIP, where if you choose to do it or you don't choose to do it, there may not be deadlines running, we included all this technical information so that you would have a resource and calendar out when this needs to get done, so you don't miss this opportunity, because you can run into, as you can see, some pretty technical problems. Let's go back to slide 15. One of the things that we have been doing, and I think we want to suggest those of you that are practicing, is to leverage software to find in the file all these NOLs. This has been a lot easier for us to find than the QIP. You just query the software, look for the line where the NOL was created, and then go in and do the analysis. So I think that that's relatively easy to find them, and that it should be something you should be working on more rapidly than not.
Mike, when can I file for it? When can I file for a refund? Let's suppose I had an NOL in 2018, and I had an income in 2019, and I used up a little bit of the NOL on a carry forward, but I still got some remaining NOL carryover. What would you do in that kind of case?
So this is what we're really doing here, is trying to use NOLs to carry back. Carry over NOLs don't generate a lot of benefit. Mm-hmm. So I'm not sure that that's the exact example that I'm looking for. I'm looking for clients that had NOLs and didn't carry them back because the old rule didn't allow you to.
Okay, so say I had 2018 NOL and I couldn't carry it back, right?
You couldn't, but now it's the same conversation we just had on the QIP. Oh, yeah. I went and found you had an NOL and looked at your 13 return and said, wow, he made a ton of money that year. Right. I would rather carry that back to 13,
and get it right away, right?
And in a high tax bracket.
Right.
So let's talk about that. I have a few situations. That's this third bullet, or the third bullet point here. I was counting on you using that NOL in 2019 and or 20, and you not having to make estimated payments. So I've been telling you all along, Leon, don't worry, you don't owe anything in July.
Right.
Now all of a sudden I call you and say, hey, Leon, we can carry that back, generate a large refund, but I can't promise you it's going to be here in July.
Right.
You want the arbitrage, or and can you cash flow it if we file that return?
I get you. So it's, again, sharpening my pencil, but it's definitely something.
And
I
the
want to act
quicker
on
the
right
better.
away.
If
Yeah.
you can file it today, the chances the refund gets processed. So let's talk about that specifically. The federal government has a expedited process right now where you literally are faxing these into a special line for them to process it. Now I have to tell you, I just did my first one this week. I haven't seen the money come back yet.
Right.
But the fact that the government recognizes the urgency and has created a queue for emergent refunds infers to me that you'll get the money. Worst case scenario, I'll tell you, let's go for the arbitrage, get the refund, and if we have to, ask for an installment payment on the current return until you get the money back.
So if I'm assembling my data to make this work, I need to see what my income was in 13, 14, 15, 16, 17, 18, 19.
Same data you need for Quip.
Yep. But in Quip's kind of limited because that's only people that have qualified property.
Correct.
This is everybody.
Correct.
This
Everybody
is a
that had
bigger deal.
this is everybody that had a loss, which
This is
honestly,
a big deal. Yeah.
It is, but in 2018 and 19 until March, the economy was pretty strong. There
Right.
weren't that many. I don't have that many in our portfolio of clients. There are less than you would think that have losses, largely because the economy was good then. So it is a big deal for someone who has a loss because they're going to get an immediate check they didn't get before. But it's
Right.
not a large population, is what I'm seeing.
So if I was using like a 168K or a 179 deduction and I generated a loss, I can still use this then, right? If I generate a loss in 18 or 19, doesn't matter how I created it, right?
Right, but 179. But which type of loss?
A 179 or a 168K bonus depreciation? Or,
Yeah, so 179, you can't create a loss with 179. You can create a loss with bonus depreciation, but I don't believe you can create or increase a loss with 179. You just go to zero.
Yeah, so if I use the 168K, it would work.
Yes, if you use bonus depreciation, if you use bonus depreciation, you could generate a pretty significant loss.
So what we should be telling everybody is you should be going back and take a look at these returns right now.
And frankly, if you are a professional on here, you should already have run a query on your database and know who your clients are that have this. And for clients who haven't heard from their tax professional, they should call them and remind them, hey, I had a loss in 18. I had a loss in 17. I need you to look at it now.
Difference between pass-through entity, non-pass-through entity, C Corp, and there's obviously a difference on the Michigan return. What's the difference on a pass-through versus a C Corp?
Well, if it's a pass-through, obviously you're going to, as Mike described, you're going to file it on your 1045 because it'll in effect be your individual return that carries it back. Okay. As opposed to if it's a corporation, it would be the corporate carryback claim.
What about Michigan? What do we do?
Well, let's talk about Michigan because, and Mike, you're going to have to help me with this one. Mike and I have struggled with this. There is a provision in the federal law that allows you, to elect not to carry back these NOLs. You don't have to do this if you don't want to. So the question is, and our experience has been, Michigan has been slower than the federal government in providing refunds. There's no rate arbitrage in Michigan. The rates are roughly the same. So the question is, do you relinquish the carryback so that you don't get stuck waiting 2 years for a refund for a tax that may be due in July?
Okay. So it's a harder question. It's not as easy a question. On the Fed, jump on it.
You can also deviate too from the federal rule in that generally speaking, Michigan follows the federal rule in that you can carry back the losses to the extent that the federal rule allows. If the losses are carried back for federal purposes, Michigan, you can relinquish the carryback for Michigan purposes and vice versa. But it's also important to note that that's only available under the in the individual context. Corporation can only carry losses forward on a Michigan return.
And unfortunately, Leon, if you're in 4 or 5 or 6 different states, you're going to have to look at every state's consideration and whether they do or they have or have not adopted the CARES Act. So there's a research project. If you have a lot of states involved in your business, say you're in 20 states, this becomes complicated. The federal claim is simple, although state claims become difficult to manage.
And what Mike is saying is I can disengage state and fed if I want to.
Certainly in Michigan you can.
Correct.
Okay, great. Thanks, guys. Complicated topic again, but you know, I think it's really important. This is probably one of the most important things we need to look at, isn't it?
If you have a loss, this is going to generate immediate cash.
Right away.
Yeah, right away.
Okay, good.
So
it's a PPP without the PPP paperwork. It's more
Correct.
paperwork, but it's a PPP with that you're already getting your own money back.
So sometimes we've talked about what could happen in 2020, and I just want to throw this one other issue out there that sounds like NOL that some of you may be reading about, and it's really the disaster loss provisions. The disaster loss provisions, I think, are code section 165. And there's a lot of conversation about, is 2020 going to be eligible for disaster loss and writing off of assets? That's a slightly different topic here than the NOL, but it may create an NOL by the time we get to the end of the year, even if your operations didn't show a loss, if there was some huge impairment or write-off that ultimately is determined from an intangible asset or whatever the assets on the balance sheet. So I will say that although we focus tonight on the ones that generate cash flow, that doesn't mean there aren't going to be a bunch of issues that by the time we get to the end of the year, we might be looking at more NOLs than we had seen.
Okay, cool. Thanks, guys.
All right, so finally, I'm going to switch over and do the last topic, which is the employer payroll credit. Pursuant to Section 2301 of the CARES Act, certain employers may be eligible for a payroll tax credit equal to 50% of qualified wages. Qualified wages are limited to $10,000 per employee for all calendar quarters. This credit shall only apply to wages paid after March 12th of 20 through January 1 of 21. Eligible employers. Those employers carrying on a trade or business during the 2020 calendar year that have fully or partially suspended their operations in any calendar quarter due to government order limiting commerce due to the COVID-19 pandemic, or employers who have experienced a substantial decline in gross receipts during any calendar quarter beginning in the first quarter of 2020. A substantial decline in gross receipts occurs in the first quarter in which gross receipts are less than 50% of the gross receipts in the same quarter from the prior year. And employers with gross receipt reductions remain eligible employers for the credit until such calendar quarter that the gross receipts recover and are greater than 80% of the gross receipts for the same quarter in the prior year. Importantly, Jim, both of these provisions apply to all operations of tax-exempt organizations. Wages that qualify the credit are as follows. Importantly, there's 2 sections here. For employers who have on average over 100 full-time employees, qualified wages include only wages paid to employers who are no longer providing services. Essentially, employer has retained employees during the eligible period, continued to pay them, but the employee is not working. Relatively rare. For employers who have on average less than 100 full-time employees in 2019, qualified wages include all wages paid to employees while the trade or business operations are fully or partially suspended. Qualified health plan expenses are also considered qualified wages if paid and incurred to provide and maintain a group health plan. There's been a little bit of a debate on this. There's an FAQ 65 out there that created some confusion, but the Treasury recently indicated a clarification that it will be revising that FAQ 65 and allowing healthcare to be included as a qualified cost. Qualified wages do not include wages paid for the family first medical leave, Next. They also have a limitation in there that you can't increase wages, so they've made sure that wages are limited to a similar wage for the 30 days prior to the qualifying period. There's obviously an overall limit of 10,000 for all 3 calendar quarters that the credit is available, and related party rules do apply to determine whether you are above or below the 100-person limit. Credit calculation is relatively simple. It's 50% of the qualified wages paid with respect to each employee during the calendar quarter. The credit is reduced by a variety of credits on the 941, the family paid leave and paid sick provisions, the qualified veterans, and the R&D credit. All of them remain, any available extra credit is treated as overpayment of tax and is refundable. There are some special rules that apply. Employers receiving the Small Business Act loan under 7A shall not be eligible for this credit. Credits claimed prior to receiving a 7A would be subject to recapture. This was obviously a big issue in the last few days in clarifying whether people were going to be paying back that loan. But with the recent clarity, I suspect less loans have been paid back, so this credit may be applied to that, may be less applicable. No credit is allowed under this provision for the work opportunity, and employees can take into consideration anticipated credits under this provision when making deposits employment taxes. That's critically important. This is self-funded. You can stop making your current payroll taxes for this credit if you want to. So unlike just like the other provision where we said you didn't have to go to a bank, get it approved, get it applied, this is self-managed. The credit is obviously only available with respect to wages after 3/10 and before January 21. And if you want, you can elect out of it. So just like the last section, I'd like to talk about some of our takeaways on this. One of those is, even though you would otherwise meet the qualifications, there is this issue that it may be difficult to use the credit given the substantial downturn the business must experience in each quarter to continue paying, still paying the wages. In addition, in many circumstances, the employee may be economically better off remaining on unemployment. That's been a continuous conversation. And this can be effective for any enterprise not eligible for the PPP. So this is where we really see the largest opportunity is nonprofits that are not a 501c3.
So Mike, a 501c6 like the MICPA or a Troy Chamber of Commerce, or?
Yes, they would appear to be eligible and immediately generate cash flow from this.
So we got a couple questions on this so far. Winona wants to know, if you get the PPP, are you eligible for the credit or not?
The answer is no, but if you pay it back, FAQ 45 says if you pay the PP back, it's as if you never got it, so you are eligible.
And then Stu, my good friend Stu, how are you, Stu? Wants to know, you don't always have a reduction in gross receipts equal to 50% to get it?
No, there's two choices. The first choice is you were under an order to close and you had under 100 people, or you had a reduction in 50%.
So let's just say, for example, I had an association of CPAs that was a 501c6, and the governor of the state of Michigan had an order to close, which means we couldn't go in the office and we had to stay at homeowner. And even though we think CPA associations are essential businesses, they aren't, probably. So would they be eligible for something like this?
If they have under 100 employees, I think they are eligible.
Well, they have under 100. I mean, I'm pretty sure the director of marketing doesn't really work, but he would constitute an employee technically, I'd say.
He works hypothetically, and hypothetically, education is a big piece of our business, and all of our live in-person educational events have been suspended until who knows. So that is I would say that is a big impact to business, not to mention all of the adjustments financially that we've had to make to continue to deliver what we provide our members with. So there's that flip too.
Mike, how would a 501c6 hypothetically file for?
Okay, let's go to the next page.
Okay, let's go to the
Thank you.
next page.
Thank you, Leon.
No problem. I'm always here to help.
The IRS just issued a revised 941 and the instructions, which are pretty clearly describe how to claim the credit. And importantly, they also issued Notice 2020-22, which I would rely on to ensure that you're not subject to penalty or interest for underpayment under this program. And so ultimately, just the other day, this 941 was filed. I would go pull it down and the instructions. You'll see some new lines on it. I think line 13 is where you ultimately claim the credit on your 941. And in the meantime, you would be reducing your deposit weekly for the benefit of this credit.
Cool. That was really helpful. I think there's a lot of people want to know about that. We are getting some interesting things. Stu, summarizes for us. It's almost all non-essential businesses this is applicable to.
When you say non-essential, it's everybody other than government. So yes,
Right.
I think it's everyone that if you didn't get a PPP loan, you would be eligible.
But if I were an essential business, then I wouldn't be under the governor's order, right? So I'd have to pass the 50% reduction in gross revenue test.
So I'm honestly not sure of that. I'm going to have to think through. If you were still closed, if you were fully open, I would say if 100% of your operations weren't, my guess would be that you would not be eligible. But if it's partial, you would I believe the phrase in the language was partial
Right.
eligibility.
Mhm.
So if you were only allowed to do partial emergency activity at your facility, the rest of the
Sure.
employees should be eligible for that.
But if I get released, let's say at the end of Q2, the governor releases us, we kind of open up our economy. At that point in time, I'm outside of the first test, so I only am under the 50% test.
I
correct?
agree. And interestingly enough, in Michigan, as we extend this order longer and longer, the probability of a gross receipts reduction triggering is increasing all the time. So the second quarter gross receipts could get lower for a lot of these folks, which ultimately may let this go into the third or fourth quarter.
Is it Q over Q, Mike? So is it quarter over quarter or 50% reduction, or is it?
It's same quarter,
annualized?
same period. So
Same quarter, same period. Okay.
So yeah. So and there's one interesting job act that has been proposed, and that is to increase this credit to $15,000 at 80%, which would be a $12,000 credit, and define large employers as those over 1,500.
Wow.
Who do you think proposed that?
Let me wonder.
I'm guessing it's people that didn't like the outcome of the PPP.
Yes. Do you think larger employers?
Large employers that aren't large employers that have 1,500 employees, a $12,000 credit could be pretty substantial. So it'll be interesting to see in every one of these provisions that generate cash flow, what next provision in the act will be tweaked to favor one particular constituent or another. So what we learned tonight will certainly change, but for those that it applies to now, I suggest that you get the money.
Linda Cush is one of our best viewers because she's always asking great questions. I should send her a gift card or something, but I'd rather just, shake her hand in person when I get a chance. Linda asked what happens on the HEROES Act, and I'm abashed to say that when CARES came out, I immediately stayed up all night and read all 883 pages and digested it and wrote a Forbes article on it. I haven't had the stamina to read the HEROES Act, only because from what I hear in Capitol Hill is it's dead on arrival when it hits the Senate. Linda's question is, are they going to change around the PPP? Are they going to do other things? We have now hit what I would call political diatribe. We went from emergency triage into now I would suggest political triage. So Linda, I apologize on behalf of my role as our resident nerd. I haven't read the HEROES Act in total yet, so I can't tell you whether it contains some of those provisions. Right now, and on the MICPA, we've been posting on our Connect to all our members everything that happens. I mean, we posted what the Treasury regs from yesterday on partnerships. We posted some of the new FAQs like Mike brought up, the one on the safe harbor under 2 million, things like that. So we'll keep, everybody stay tuned. This isn't over, but Mike and Mike, I think this was a great
I
session.
got one more to go. I got a quick slide, and I'm going to go fast.
You
'cause I
better
know-
go fast and not dry this time. Wetting it up, man.
Yeah. So there is one more deferred payroll tax payment, that provision that's out there, Code Section 2302, and that allows employees to employers to delay payments of the employer's share of the Social Security tax, the 6.2%. The payroll tax program begins on the enactment of the CARES Act and ends in January 2021. The deferred taxes must be remitted over 2 years, half in December of 21 and the remainder in December 22. Taxpayers that have a 7A loan issued and it is not, that are forgiven, let me read that carefully. Taxpayers that have Section 7A loans issued under the Act that are forgiven are ineligible for the deferral. So if you ultimately get forgiveness, you don't get to use this. I want to go to the next slide because I know we're running out of time. This one's interesting. It provides clear exemption from interest and penalties under the same notice. It's the same issue. It's self-managed, self-claimed, and it's interest-free. So in my mind, if you like it, it's better than the PPP. And the question I have, I guess, for the panel is, historically, when my clients couldn't pay their payroll taxes, I was scared to death. I thought they were on their way out of business. Do you think that using this technique has anything to do with the health of the business, or is it a valid strategy to borrow money interest-free?
Bob, what do you think?
Oh, you know, you're in a space where I don't play a whole lot. Typically for us, our payroll taxes weren't that significant. So going through the administrative headache of trying to track this thing through, I typically told people not to do it because I was afraid they might have cash flow issues in 21 and 22. But you know, if you've got the capital and you've got the discipline in the systems, it's a great way to get a deferral.
Mike, I'm playing with a shirt sleeve calculation because I like to do that, and I'm writing on my shirt sleeve because I've been wearing the same shirt twice. But my shirt sleeve says if I got $1.2 million a payroll, I got 100 grand over. I could potentially qualify for a 250 PPP loan. If I kept paying it, I could get a forbearance on the PPP, which would give me potentially 200 grand in my pocket, something like that, 190 grand, 180 grand. I'm making $6,200 by not paying my payroll taxes. I don't know. It seems like a PPP could be better. And obviously, if I didn't get the PPP, it's easy.
That's the issue, Leon. I think the PPP, as it was originally designed, was clearly better. Then these provisions all of a sudden had some shine to them as that PPP became very difficult to manage. Now, and you know, I guess it depends on Bob's calculator on what we ultimately get forgiven and whether you got the money in the right window. But I do think there's a calculation. And certainly for a place like the MICPA that didn't get the PPP, they should be eligible for both of these. Right. And at the end of the day, my thinking has come around. I think that anywhere you can borrow money using any leverage, if you need that money and you've designed, and where else can you borrow interest-free?
Yeah.
So I don't think this is the same as my clients that over the years didn't have the discipline to pay their payroll taxes.
Yeah, where we're using this heavily is with a lot of the smaller nonprofits that either didn't have the systems or didn't, in a timely manner, didn't get a PPP, or like the 501s that can't qualify for PPP. You use the retention credits, the employee, retention credits, and you use the payroll deferrals. They just make sense. It's your plan B.
I completely agree.
Well, guys, we're going to wrap it up. I want to thank all the panelists for all 4 of our sessions. I think they've been really good. I really want to thank the MICPA for putting this out there to members and to the general public. Mike and Mike, thanks for being on this and giving us some great tips on how to get money in our hands. Gary, thank you for your presentations on constraint theory and some of the things we can do. Bob, your PPP was amazing. I thought it was a great type thing. I look forward to having everything you said being changed within the next week or so. I would just say to everybody, stay tuned. We're in a flux environment. Everything is completely changing, and everything out there is in flux. I've never seen so much change in 10 weeks, where I've seen bull markets and bear markets and upheavals in the SBA loan system and upheavals in the unemployment system, and basically the Fed take out an aircraft carrier and put it into the economy. All of us have to recognize that the new paradigm has shifted, and that we're in a new world, and that we have to be able to address this new world. So I just want to tell everybody, hey, thanks for being here and thanks for listening to us.